Welcome to our exploration of investor psychology, a crucial yet often overlooked aspect of successful investing. Understanding how our minds work when making financial decisions can be the difference between consistent gains and costly mistakes. In this video, we'll uncover the mental patterns, biases, and emotional triggers that influence investors, both novice and experienced. By the end, you'll have a clearer grasp of why you make certain choices and how to harness your psychology for better investment outcomes. Let's begin our journey into the fascinating world of investor psychology. Emotions play a significant role in investment decisions. Fear and greed are two powerful forces that can drive market movements and individual choices. When markets are volatile, fear can lead to panic selling, while greed might push investors to chase after hot stocks without proper research. Recognizing these emotional triggers is the first step toward managing them. By understanding how emotions influence your actions, you can develop strategies to stay calm and rational even when the market gets turbulent. Cognitive biases are systematic errors in thinking that affect our investment decisions. Common biases include confirmation bias, where we seek information that supports our beliefs, and overconfidence, which can lead us to underestimate risks. These biases can cloud judgment and result in poor investment choices. By becoming aware of these mental shortcuts, investors can take steps to minimize their impact and make more objective decisions. Herd mentality describes the tendency to follow the crowd, especially during market booms or crashes. When everyone is buying, it's tempting to join in, fearing you'll miss out. Conversely, widespread panic can trigger mass selling. This behavior often leads to buying high and selling low, which is the opposite of successful investing. Understanding herd mentality helps you resist the urge to follow the crowd blindly and stick to your strategy. Loss aversion is the tendency to prefer avoiding losses over acquiring equivalent gains. This means the pain of losing money often feels stronger than the joy of making money. As a result, investors might hold onto losing investments too long or sell winners too early. Recognizing loss aversion can help you make more balanced decisions and avoid letting fear dictate your actions. Overconfidence can lead investors to believe they have superior knowledge or skills, causing them to take excessive risks. This bias often results in underestimating market volatility or ignoring warning signs. By staying humble and acknowledging the limits of your knowledge, you can avoid costly mistakes and make more prudent investment choices. The anchoring effect occurs when investors rely too heavily on the first piece of information they receive, such as a stock's initial price. This can skew future decisions, making it hard to adjust to new data. Being aware of anchoring helps you remain flexible and responsive to changing market conditions. Confirmation bias leads investors to seek out information that supports their existing beliefs and ignore evidence to the contrary. This can reinforce poor decisions and prevent learning from mistakes. To counter this, actively look for diverse viewpoints and challenge your assumptions before making investment moves. Recency bias is the tendency to give more weight to recent events when making decisions. For example, after a market rally, investors might believe the trend will continue indefinitely. This bias can lead to poor timing and missed opportunities. Remember to consider long-term trends and historical data, not just recent performance. News headlines can have a powerful effect on investor sentiment. Sensational stories often trigger emotional reactions, leading to impulsive decisions. It's important to verify information and avoid knee-jerk reactions to news. Developing a disciplined approach to news consumption can help you stay focused on your investment strategy. FOMO, or the fear of missing out, can drive investors to jump into trends without proper analysis. This emotional response often leads to buying at the peak and suffering losses when the trend reverses. To combat FOMO, stick to your investment plan and remember that opportunities are always around the corner. Successful investing often requires patience. Markets can be unpredictable in the short term, but long-term strategies tend to yield better results. By resisting the urge to react to every market movement, you can avoid unnecessary losses and let your investments grow over time. Understanding your own risk tolerance is essential for building a portfolio that matches your goals and comfort level. Some investors can handle volatility while others prefer stability. Assessing your risk profile helps you make choices that you can stick with, even during market downturns. Diversification is a key strategy for managing risk. By spreading investments across different assets, you reduce the impact of any single loss. This approach helps smooth out returns and provides a safety net during market turbulence. Remember, don't put all your eggs in one basket. Setting clear, realistic investment goals keeps you focused and motivated. Whether you're saving for retirement, a home, or education, having specific targets helps guide your decisions and measure progress. Adjust your goals as your life circumstances change to stay on track. Impulse decisions can derail your investment strategy. Acting on a whim, whether buying or selling, often leads to regret. Establishing rules for yourself, such as waiting 24 hours before making a trade, can help you avoid emotional reactions and stick to your plan. Every investor makes mistakes, but the key is to learn from them. Reflecting on past errors helps you identify patterns and avoid repeating them. Keep a journal of your investment decisions and outcomes to track your progress and growth over time. Thorough research is the foundation of sound investing. Don't rely solely on tips or trends, instead, analyze financial statements, industry trends, and company fundamentals. Informed decisions reduce risk and increase your chances of success. Discipline is essential for long-term investment success. This means sticking to your strategy even when emotions run high or markets are unpredictable. Regularly review your plan and make adjustments based on logic, not impulse. Friends, family, and colleagues can influence your investment decisions, sometimes unintentionally. While it's helpful to discuss ideas, make sure your choices are based on your own research and goals, not just others' opinions. Markets move in cycles with periods of growth and decline. Understanding these cycles helps you manage expectations and avoid panic during downturns. Stay focused on your long-term strategy rather than reacting to short-term fluctuations. Speculation involves making high-risk bets in hopes of quick profits. While it can be tempting, especially during market hype, it often leads to losses. Focus on building wealth steadily through informed, long-term investments rather than chasing quick wins. Many investors believe they can control market outcomes through skill or timing. In reality, markets are influenced by countless factors beyond anyone's control. Accepting this can help you focus on what you can manage: your strategy, risk, and emotions. Markets and personal circumstances change over time. Being adaptable allows you to adjust your strategy as needed. Regularly review your portfolio and be open to making changes when new information or life events arise. Too much information can lead to analysis paralysis, where you're unable to make a decision. Set clear criteria for your investments and trust your process. Sometimes making a timely decision is better than waiting for perfect certainty. Compounding is the process where your investment earnings generate their own earnings over time. This powerful effect can significantly grow your wealth if you stay invested and reinvest your returns. Patience and consistency are key to harnessing compounding. Unrealistic expectations can lead to disappointment and rash decisions. Understand that investing involves ups and downs and there are no guarantees. Setting reasonable expectations helps you stay committed to your long-term plan. Sometimes, consulting a financial advisor can provide valuable perspective and guidance. Professionals can help you clarify your goals, assess your risk tolerance, and design a strategy that fits your needs. Don't hesitate to seek help when needed. The world of investing is always evolving. Stay curious and committed to learning, whether through books, courses, or market analysis. Continuous education helps you adapt to new trends and make informed decisions. Investor psychology is a powerful force that shapes your financial journey. By understanding your emotions, biases, and mental habits, you can make smarter, more confident decisions. Remember, successful investing isn't just about numbers, it's about mastering your mindset. Stay disciplined, keep learning, and let your psychology work for you on the path to financial success.